start within. Okay. So this is income from the heads capital gains. So in the last three classes or uh, 3 hours of discussion on the topic capital gains, wherein we spoke about the definitions and the concepts of capital assets, capital gain, short-term capital gain, long-term, and all that stuff. And in my subsequent sessions, wherein I took up some numerical problems. So we'll continue with the numerical problems on the subject capital gains. And let's take the first uh, particular concept called as self-generated assets. Self-generated assets. So, what do you mean by self-generated assets? So, I will not go into these ones, but I will take up a small problem on goodwill. So, goodwill is a self-generated asset. It is a self-generated asset. Means, see, this is in the case of accountancy, we find out the goodwill of the company, and there are various methods of finding out or valuation, finding out the valuation of the goodwill of the company or the business. This is a self-generated asset. It is not acquired or purchased. This is not acquired or purchased. Rather, it is for a company like Infosys, they value at the time of what for suitable reasons they find out what is the goodwill valuation of the goodwill or goodwill's value. So this is not purchased like other assets like land, building, plant, and machinery. Despite the fact that goodwill is an asset, we don't purchase it. It is a self-evaluated or generated asset. So subsequently, see, it may so happen that the company which has just now evaluated or found out the value of goodwill, it is now going to sell itself to other company. Okay, so in the process, what is happening? Goodwill also is sold because at the time of merger or any other business reorganization, it is sold along with all the assets. So at that time, it is necessary to find out is there a capital gain which has arisen from the transaction of from this particular transaction wherein goodwill also is sold. So for a self-generated asset, and in particular, I'm talking about goodwill. There are some other self-generated assets, and one of them is route permits, so on and so forth. Okay, so goodwill is one we are going to talk about. So in case of a self-generated assets, this is the way to find out the cost of acquisition. The cost of acquisition is the purchase price at which we have purchased it. Okay, so treatment of self-generated assets which are generated before 1/4/2001. See, please remember the base year for the cost of finding out the cost of inflation index is already spoke is 2001, 2002. Previously, it was 1981, 82. Now, in the last 2 or 3 financial years back, this has been changed. The base year is 2001, 2002. So, for treatment of a self-generated asset before 1/4/2001, if the aforesaid assets are developed or purchased before 1/4/2001, the option of adopting a fair market value shall not be applicable. Even in such, the cost of acquisition shall be computed as per the above table. So we will take up a small problem, and that will help us to find out how to calculate for a self-generated asset long-term capital gain or a long-term short-term capital gain. So cost of improvement in case of goodwill. So cost of improvement, I told you, it happens in case of physical assets like a building, wherein you can carry out or take up some activities like repairs, renovation, or building a new floor, like a first floor or second floor. So there is a improvement which is taking place. But however, let's see what will the cost of improvement in case of goodwill. In case of goodwill, right to manufacture or produce, comma, right to manufacture or produce any article or right to carry on any business or profession, cost of improvement shall be nil because it's not required to take. So major examples I'm taking. So goodwill. Let's. This is the way we find out the capital gains as far as goodwill is concerned. Okay. For example, I'm just giving a small example before I speak about this particular part of the discussion. So goodwill of a business, right to carry on a business or profession, right to manufacture or right to manufacture. or process and article. So these are all self-generated assets. So goodwill is a self-generated asset, right, to carry on a business or profession, and wherein we are selling our company, right, to manufacture or process an article. And let's talk about goodwill. That will clear your concept. So, for example, Tata Motors is buying XYZ company, or it is acquiring this company. This is being acquired by Tata Motors. XYZ Limited, which is into manufacturing of auto components, is acquired by Tata Motors. So when you are acquiring, we try to find out the net sale consideration of this company. To find out the net sale consideration of this particular company, we calculate the total assets, and deduct the total liabilities, and whatever is the residual we pay towards this acquisition of the company. At the same time, when I'm talking about total assets, we have tangible assets as well as intangible assets, like land, building, plant, and machinery are tangible assets. Intangible means which can't be seen, like goodwill, patents, copyrights. So now that part of goodwill, which is going to be sold to this company, Tata Motors. How do we find out the goodwill value? Because this goodwill value also is being sold, but it is an intangible asset or a self-generated asset, and it is being sold. And I am telling you that whenever a capital asset is sold, whenever a capital asset is sold, whenever a capital asset is sold, uh, please remember that we have to find out whether it is a long-term capital asset or a short-term capital asset, and whether there is a from this transaction of long-term or short-term, we find out long-term capital gain or short-term capital gain. So in this case also, goodwill is sold. So goodwill, as we have already spoken, is a capital asset. And now it's time to find out from the sale of this goodwill by this company to Tata Motors whether there is a capital gain or not. So how do we find out? What is the procedure to find out the long-term or short-term capital gain arising from the transaction of selling the capital asset, which is goodwill in our case? So sale consideration. So for this case, for example, goodwill is sold. So, for example, it is sold for 100 crores. So, this is the sale consideration. Cost of acquisition. There is no cost of acquisition because it is a self-generated asset. So, for a self-generated asset, and in particular goodwill, there is no cost of acquisition, and on top of it, even there is no cost of improvement, and so there is no total cost of acquisition or improvement, and whatever is the expenditure incurred on the in the process of selling this goodwill. So if there is an expenditure that you have to deduct from net sale from sale consideration to arrive at the net sale consideration. So in this case, the capital gain will be the total cost, and this total cost of acquisition and improvement is zero. So net sale consideration will be the long term or short term capital gain. So sale consideration less capital expenditure on transfer of asset. Now let's take a small example, and we will solve the problem. Let's take a small example and solve the problem wherein there are four capital assets. One is land, which is acquired before 1/4/2001. Goodwill, uh, and the business was commenced in the year 1988. And tenancy rights is the third particular capital asset, and goodwill of the profession. And this activity started in the year 1989. So the cost of acquisition is given, and if you look at this, tenancy rights is a self-generated asset, goodwill is a self-generated asset, and so hence you can see the cost of acquisition is zero. Now, as far as land is concerned, the cost of acquisition in 1985 is 1 lakh rupees. Now, when any asset is purchased before 1/4/2001, there will be fair market value as on 1/4/2001. So the fair market value is 5 lakh rupees in case of land. Whereas in case of goodwill, there are certain amounts given. We'll see whether they have to be considered for the purpose of calculation of capital gains. And now this land, the goodwill of the business, the tenancy rights, and the goodwill of the profession all these assets, capital assets are sold. Land is sold at 75 lakh rupees. Goodwill is sold at 5 lakh rupees. Tenancy rights are sold at 2.5 lakh rupees. Sorry, 2 lakh 50,000. And goodwill is sold another of the profession at 10 lakh rupees. And the brokerage charges which are incurred in the process of selling these capital assets are 2% on the sale value. So let's calculate the the total capital gains from this particular transaction. Okay, so as far as let's talk about land. Let's talk about land. Land is sold for just a moment. 10 lakh rupees currency. Okay, okay. Land is sold for uh, land is sold for 75 lakh rupees, and so 75 lakh rupees. Number one. Number two, 2% is incurred for transfer on transfer, so 1.5 lakh rupees. So the net sale consideration from the sale of land is 73 lakh 50,000 rupees. Now we have to find out the indexed cost of acquisition, because it is a long-term asset, and the reason why it is a long-term capital asset is because this asset was purchased in the year 1985. So almost 15 plus 20, 1934 years old capital asset. So if it more than 36 months old, then it is a long-term capital asset. So for a long-term capital asset like building, indexation is permissible, is permitted. So the formula for indexed cost of acquisition is cost of acquisition, cost of acquisition into CAA of the year of transfer by CA of 2001 2002, because uh, this particular asset of land was acquired in the year 1985. So 1984, any asset which is purchased before 2001, we have to take the fair market value, and when fair market value is taken for the year 2001 2002, so the base year, which is the base year, the cost of inflation index is 100. So 5 lakhs into 289 by 100, the cost of index cost of acquisition as far as land is concerned is 14 lakhs 45,000 rupees. So 14 lakh 45,000 worth of land has been sold at 73 lakh 50,000, and thereby the uh, the long-term capital gain. This is a long-term capital gain is 59 lakh rupees, 59 lakh 5,000 rupees. Hope this is clear. Now let's take the second problem. Next, take the second problem, which is goodwill of a business and goodwill of profession. So goodwill of a business is 1 lakh rupees. Goodwill of a profession is 2.5 lakh rupees. Okay, let's take. So goodwill of business. So goodwill of business was sold for 5 lakh rupees. As you can see, it was sold for sorry, goodwill of a business was sold for 5 lakh rupees, and it was the fair market value of goodwill on 1/4/2001 was 1 lakh rupees, and the purchase price, because it is a self-generated asset. For a self-generated asset, goodwill is zero because it is not acquired, neither it is purchased. So let's take up the solution. So the sale consideration is, as far as goodwill is concerned, is 5 lakh rupees. I told you the expenses incurred on transfer of all these assets are 2% on the sale value. So 5 lakhs into 2% is 10,000 rupees. Now the net sale consideration is 4 lakhs 90,000 rupees. And now, can you go for index cost of acquisition or cost of acquisition? No, because the cost of acquisition in case of self-generated assets, as already told, is nil. So the value of it is nil. So this is the cost of acquisition, and it is sold for 4 lakhs 90,000 rupees, and hence it is a case of long-term capital gain of 4 lakh 90,000 rupees. Now the question arises, why it is a long-term capital gain? Because this asset is sold after 3 years from the date of acquisition, because this particular business started in the year 1988. So this is almost 30 years old business. And if the asset is sold after 3 years from the date of acquisition, the asset is a long-term capital asset. And in this case, the long-term capital asset has generated a long-term capital gain of 4 lakhs 90,000 rupees. So you have to pay 20% tax on this one, which is long-term capital gain tax. So this is the second part of our discussion. Now let's take the third problem of the numerical problem. The third problem is tenancy rights. So tenancy rights also is a self-generated asset. So here the cost of acquisition is zero. The market value is given, but it has to be disregarded because in case of a self-generated asset, the acquisition price is zero. And these tenancy rights are sold for 2.5 lakh rupees in the year 2019-20 on 12/12/2019. Now let's calculate the whether the asset is now in this case there is no clear identification of when these tenancy rights were purchased. So it will be a long-term capital gain or short-term capital gain. We will see into that. So tenancy rights are sold for 2.5 lakh rupees, and 2% is the cost incurred for transfer, which is 5,000 rupees on this one, 2%. So the net sales consideration is 2,45,000 rupees. Okay, and now the cost of acquisition is zero, and the index cost can't be done. So there is a capital gain to the tune of 2,45,000 rupees. So I will have to see whether it is a long-term capital gain or a short-term capital gain. I will clear this doubt in the next session. Okay. Now, as far as transfer of now fourth particular situation is goodwill of a profession, which is a profession of almost 30 years old, which was acquired at zero because self-generated assets it is zero, and the fair market value was 2.5 lakh rupees, and 10 lakhs is the sales value. So please look at the note. Transfer of a goodwill of a profession, even if it is a self-generated, is not covered by section 55(2)(a). Hence, shall not be chargeable to tax. So self-generated assets of in the form of transfer of goodwill of a profession are not taken into consideration, and hence they are not chargeable to tax under section 55(2)(a). So this is the important point. Next one, see, there are different assets, and the assets are acquired and sold. So for example, land, building, plant and machinery, and we spoke just now tenancy rights and goodwill. Now the time has come to take up a new asset, which is bonus shares, which is bonus shares, capital gain in case of bonus shares. Now, what do you mean by bonus shares? Bonus shares are nothing but these are the shares which are issued by the company to the shareholders who are entitled if they are holding these shares on the record date. Now, what do you mean by bonus shares? See, we have equity share capital on the liability side of balance sheet, and we have reserves and surplus. Okay, so for example, the equity share capital consists of 1,000 shares of the face value of 100 rupees, and the total equity share capital is 1 lakh rupees. The reserves and surplus, are some 50 lakh rupees. So here the total equity share capital and reserves and surplus, which is called as net worth, is equal to 51 lakh rupees. Now the company has taken a decision to issue bonus shares to the shareholders of the company, existing shareholders of the company. Now, what do you mean by bonus shares? Bonus shares is nothing but capitalization of reserves. It is nothing but capitalization of retained earnings, capitalization of reserves. Now, what do you mean by capitalization? So I will explain what do you mean by capitalization. Capitalization is nothing but in this slide I will show you. So 1 lakh rupees was the equity share capital, and 50 lakh rupees was the reserves and surplus. 50 lakh rupees was the reserves and surplus. This is 1,000 shares of rupees 100 each. 1,000 shares of rupees 100 each. Now company is thinking of issuing bonus shares, and they have come out with a bonus shares issue of, for example, 20:1. 20:1 means what? If a shareholder is having one share, for example, okay, I am just taking an example. For example, if a shareholder is having one share, he is going to get 20 shares. So total, how many shares are there? 1,000 shares are there. Okay, for example, I will just increase this one to 200. Means for every one share, held by the equity shareholder, you are going, that shareholder will get 200 shares. And in this case, there are how many shares? 1000 shares. So you have to just multiply it with 200. So how many shares will be there henceforth? There will be 2 lakh shares. What was the face value? The face value uh, was 100 rupees. So 2 lakhs into 100 rupees, 2 lakhs into 100 rupees. Okay, I will change this ratio, okay, to 20 only, because it can't be capitalized. So for every one share, you is going to get 20 shares. So here, how many shares are there? 1000 shares are there. So how many shares will be issued to this total 1000 shares? 1000 into 20, 20,000 shares will be issued. And what is the equity share capital? Sorry, face value. The face value is 100 rupees. So it is 20,000 into 100 is equal to 20 lakh rupees. So this will, the new equity share capital will become 20 lakh rupees. And this will be reduced. The results will be reduced by that amount which has been transferred from this to this. So this is called as capitalization of profits. So this is not a income tax concept, but generally bonus shares are issued from bonus shares are issued from equity share capital reserves and surplus, and they are and this reserves and surplus are capitalized, means converted into capital. So with this particular background, let's talk about how to find out whether there is a long-term capital gain or a short-term capital gain, and how do you find out the cost of acquisition in case of shares which are issued for on the basis of bonus. Bonus shares are nothing but, please remember, very important concept. Bonus shares are free shares, or free shares, free shares. For example, I have invested some money in stock market in acquisition of Infosys shares, for example, 100 shares. And after 2 years, they have declared a bonus of 20 shares for 100 shares. So I am getting 120 shares. So it was previously 100 shares. Now this is another 20 bonus shares were given, and today I got a total equity shares in Infosys of 120 shares. So these 100 shares were acquired for a particular price at a particular date. Whereas in case of bonus shares, these bonus shares don't have acquisition price. These are free shares, we call it. Free shares means they are not, they are freely issued by the company in the form of bonus. Bonus is free. So they don't have any acquisition value. The acquisition value is nil, or the cost is nil. And subsequently, after some time, like 2 years, 3 years, all these shares are sold. So in such a case, we have to find out what is the total profit I am earning, what is the gain I am earning, what is the capital gain I am earning, whether it is a short-term capital gain or a long-term capital gain. So let's take a small note of how to solve this numerical problem related to bonus shares. We have even right shares also. We'll see that one also. So sale consideration is how many shares were sold at what price. For example, 120 shares were sold at 5,000 rupees. Expenditure on transfer. So whatever is the expenditure which has incurred on the transfer of this number of shares will be deducted from the sale consideration to arrive at the net sale consideration. Next, period of holding. For example, I purchased on 1/4/2008 and sold in 2020, but bonus shares were issued on 1/4/2012. So what is the period of holding as far as this one is concerned and this one is concerned? Because this were the shares which were purchased, and this were the shares which were issued as bonus shares. So starts from the date of allotment of such shares. Date of allotment of such shares. When we are taking a problem, at that time your concepts will be clear. Next one, cost of acquisition. Because now bonus shares are free, whereas the other shares are having a cost because I have purchased it. The assessee has purchased. So if bonus shares are allotted before 1/4/2001, then the fair market value has to be taken into consideration. If bonus shares are issued before 1/4/2001, the fair market value of such bonus shares on 1/4/2001 has to be taken for the cost of, for finding out the cost of acquisition. And if bonus shares are allotted on or after 1/4/2001, the rule is something different. The value of the bonus shares is nil. So with this background, let's take up a small problem. and the problem is in front of you, and it's a very important problem as everybody who is practicing uh, uh, as a chartered accountant or a income tax practitioner should be able to solve this problem, because there can be real time problems of this kind, and you should help in giving proper consultancy to the assessee. So the problem goes like this. So the rest acquired 10,000 shares of Coffee Tea Limited. This is the name of the company at 100 rupees. So this 10,000 shares were acquired by the assessee at 1,100 rupees each on 1/12 to 1995. So these assets or the shares were purchased before 1/4/2001. So certainly there should be element of fair market value. Let's see whether there is a yes, we got a fair market value, because please remember, whenever the asset is purchased before this date, certainly in the problem there should be a fair market value of this asset. That is the equity shares in this particular case. Okay. Now number two. Now number two is this company has declared a bonus on 31st March 1999. So I told you in the previous slide, if any bonus shares are allotted before 1/4/2001, then what should we take? The fair market value. And if the bonus shares are allotted on or after 1/4/2001, then the fair market value is not considered. The value of such bonus shares which are issued by the company on or after 1/4/2001, the purchase is nil. The purchase price is nil, or the cost price is nil. So there is a the concept which should be understood and remembered by you. So in this case, this company has issued bonus shares in the ratio of one bonus shares for every one share. So previously he has got 1,000 shares, 10,000 shares, and by virtue of holding this many number of shares, and the ratio is 1:1. Now this guy will get for every one share. So he has got 1,000 shares. So he will get another 10,000 shares. Now these are totaling to 20,000 shares. So on this date, he has got 20,000 shares with him, out of which 10,000 shares were the old shares, which were acquired at 100 rupees each, whereas the other 10,000 shares, which were acquired on 31st March 2019, were bonus shares. So this is number two. Number three, again on 1/6/2019, company further declared a bonus of one bonus share for every two shares. Now, how many shares were there at this time when they declared the bonus? 20,000 shares were there. And the ratio is 2:1. Sorry, 1:2. For every two shares held, he will get one share. So, in this case, he has 20,000 shares. So, he will get another 10,000 shares, because one bonus share for every two shares held. So, for two shares, he will get one share. Means for 20,000 shares, he will get another 10,000 shares. The total number of shares, including the previous 20,000 plus another bonus of 10,000, will be 30,000 shares. But this, remember this date. This date was on 1/6/2019. So yes, so if it is sold on 1/1/2020, it is a short-term capital gain, because it is sold within 6 months. So with this, the rule is if it is sold within 12 months, then there is a short-term capital gain. And on 1/1/2020, Rocky sold all the shares. How many shares were there? 10 plus another 10, 20 plus another 10, 30,000 shares are there. I don't know whether how many shares I have taken. Okay, small mistake is done. Okay. So 30,000 shares were there. And he sold these 30,000 shares for 950 rupees in the financial year 2019-20 on 1/1/2020. So hope this discussion as well as the problem is concerned is solved. Now let's take up the solution to this one. So on 1/12/1995, he has got 10,000 shares. So total number of shares on this date were 10,000 shares. On 31st March 1999, the company declared a bonus in the ratio of 1:1. Means for every one share he has hold, he will get another one share. So how do you calculate it? So 1:1, and he has got 10,000 shares. So just cross multiply it and divide by 1. So 10,000 into 1 by 1 is equal to, he will get 10,000 shares. So previously old shares were 10,000 and bonus shares are 20,000. So hope this is also clear to you. Now again on 1/6/2019, the company declared bonus of 1:2. Means for every 2 shares held by you or the assessee, he will get 1 share. So 1:2. Now let's calculate how to solve the number of shares. That is, for example, 1:2. So for every, so he has got 20,000 shares. 20,000 shares. For every 2 shares held, he will get 1 share. So cross multiply it. So 20,000 into 1 by 20,000, sorry, 2, he will get 10,000 additional shares. So I just made a small mistake. This is to be changed to 10,000 shares. Okay, I'm just rectifying that. So this is 10,000 shares. So previously, up to this stage, he got 20,000 shares. Now, on this date, when the company declared bonus of 1:2 means for every 2 shares held, he will get 1 share. So he had 20,000 shares, he will get half of it, which is 10,000. So total number of shares are now 30,000 shares. Now, if you look carefully, how to bifurcate this 30,000 shares, just pay attention. The bifurcation goes like this. So 30,000 shares are there with him right now. 30,000 shares are like this. Old 10,000, bonus 10,000, another bonus 10,000. And this bonus was declared before 1/4/2001, and this bonus was declared on or after 1/4/2001. So in this case, the value is nil. In this case, the cost of acquisition is nil, and in this case, it is a fair market value. And the fair market value is given in the problem. If you look at the fair market value, if you look at the fair market value on 1/4/2001, if you look at the fair market value on 1/4/2001, it is 250 rupees. Now look at this 100 rupees and look at this 250 rupees. And now we will solve the problem. The problem is in front of you. The solution now is in front of you. Okay, let's solve the problem. Now, this is the original shares. This is the bonus shares which were declared before 1/4/2001, and this is the bonus shares which are declared after 1/4/2001. I will make a small slight change. This is 10,000 shares. Okay, please remember that. Now, it has been informed in the problem that he is selling all the shares, 10,000 shares, 10,000 shares, and 10,000 shares for 950 rupees. So, first case, 10,000 shares at 950 rupees, 95 lakhs. If I am correct, it is 95 lakhs. Is okay. In the second case, 10,000 shares at 950 rupees, 95 lakhs. In the third case, 10,000 shares at 950 rupees, because this is not 5,000 shares, 10,000 shares, again 95 lakh rupees. So here in the problem, the net sale consideration is calculated, and it is given in the problem that there is no transfer commission on transfer. So that part is also taken into account. So commission or expenses on transfer is zero in all the cases. So the net sale consideration. So this minus this is equal to 95 lakhs minus 0 is equal to 95 lakhs. 95 lakhs minus commission is 0, which is 95 lakhs. And this case also 95 lakhs minus 0 is 95 lakhs. So this is the total amount of money what he has got. But what has happened? We have to find out the cost of acquisition. Cost of acquisition will be there because he has purchased these shares. Some of them are bonus, some of them are free. Some of them are free shares, and some of them are acquired. Now the first case was the case where it was acquired. So in the case of the first one, let's find out the indexed cost of acquisition. Why? Because these shares were purchased in 1985 and sold in 1920. So almost 30 years or 35 years old shares. So if the shares are purchased and sold after one year or 12 months from the date of acquisition, then it is a long-term capital asset. then it is a long-term capital asset. Already I told at the very beginning of our discussion as far as the concepts of long-term capital assets and short-term capital assets. So we have to do indexation. You have to do indexation. So this again you have to change index cost of acquisition. So formula for indexed cost of acquisition I told you is cost of acquisition into CII of the year of transfer. CII means cost of inflation index of the year of transfer by CII. Now this 250 rupees has to be compared with the original cost price at which it has been purchased. If you look here, the original cost price at which it has been purchased is 100 rupees. If you are able to see, yes, 100 rupees. This has to be compared, and this is the acquisition price on 1/12/1995, which is before 1/4/2001. So this has to be compared. This cost of acquisition has to be compared with the fair market value. This is the fair market value of 1/4/2001, and among them, whichever is highest, that has to be taken into account. So we have taken into account 250 rupees. So 10,000 into 250 rupees. Sorry, 10,000 into 250 rupees. Cost of acquisition is 10,000 shares of 250 rupees into year of transfer is 289 by cost of inflation index of the, now this 250 rupees is the market price of 1/4/2001. So 2001 2002 it is the CII is 100 units. So if you calculate this, you will get this figure 10,000 into 250, which is the fair market value as on 1/4/2001, into 289, which is the CII of the year of transfer, by CII of the year of 2001 2002, which is the base year. If you calculate this, you will get 72 lakhs 25,000 rupees. So this was the cost of indexed cost of acquisition, and this was the sale price. And if you find out the difference, 22 lakh 75,000 rupees is the long-term capital gain, because this is sold after almost 35 years from the date of acquisition. In case of shares, if it is sold after 12 months, it is a long-term capital gain. And if there is a long-term capital gain on such transactions, you have to pay long-term capital gain tax. So long-term capital assets sold and long-term capital gain is there, and on this long-term capital gain, you have to pay long-term capital tax, long-term capital gain tax, which is to the tune of 20%. So this is also over. Now let's look at the first bonus shares which was sold in the year 2019-20. So these first bonus shares were issued before 1/4/2001, and that I told you that if these bonus shares are sold before 1/4/2001, sorry. If these bonus shares were issued by the company before 1/4/2001, then the acquisition price is the fair market value on 1/4/2001. And I just now I told the fair market value of 1/4/2001 of this shares is 250 rupees. So the cost of acquisition is 250 rupees. So 10,000 shares are purchased at 250 rupees. That is what we are going to take into consideration. Now let's find out the index cost of acquisition. Why we have to find out index cost of acquisition? Why you have to employ indexation? Because these shares were issued by the company in 1999, and they are sold in the year 2019, almost 20 years later or 30 years later. Sorry, 20 years later. So if it is sold after 12 months, then it is a long-term capital asset. And for a long-term capital asset, we have to find out indexation, and index cost of acquisition we have to find out. So index cost of acquisition of bonus shares. Index cost of acquisition of bonus shares which are issued before 1/4/2001. The formula is cost of acquisition into year CII. This is common, okay, everywhere. CII of the year of transfer by CII, cost of inflation index of fair market. CII of the year of fair market value calculation. So fair market value was of 2001 2002. So the base year, which is 100 units. So it is cost of acquisition is 10,000 shares were acquired at 250 rupees. That is the fair market value as on 1/4/2001. And the CA of the year of transfer is 289, and the fair market value of 2001 2002 was considered. So the indexation, the cost of inflation index of of the base year or 2001 2002 is 100. So if you employ this, you will get this particular calculation. That is 10,000 rupees. Sorry, 10,000 units into 250 rupees. That is the fair market value as on 1/4/2001 into CIA of the year of transfer by CIA of 2001 2002, and you will get 72 lakhs 25,000 rupees as the indexed cost of acquisition. So from this, if you deduct the indexed cost of acquisition, you will get a long-term capital gain of 22 lakh 75,000 rupees. Now this is the way you calculate the bonus for bonus shares long-term capital gain if these bonus shares are acquired before 1/4/2001. However, let's talk about the third situation where the bonus shares are acquired or issued by the company on or after 1/4/2001. So in this case, this was issued on 2019. If you remember, these bonus shares were issued on 1/6/2019. So if the bonus shares are acquired or issued by the company to the assessee in on or after 1/4/2019 2001, in such a case the cost of acquisition is zero. So this is the thing which you have to remember. Now let's find out the short-term capital gain, because as I told you, these are sold after the bonus shares were issued. Within 6 months he has sold, and this is a short-term capital asset as far as this asset is concerned, and hence we will find out short-term capital gain or a loss. Now, certainly there can't be a loss because the acquisition price is zero. So let's find out the short-term capital gain. So here already I told it is 10,000 units. 10,000 units are sold, shares are sold at 950 rupees. The cost of transfer is zero. So 95 lakh rupees is the net sale consideration. And from this, the cost of acquisition is zero, because the rule says that if the bonus shares are issued by the company, or you look here, if we look at this point, if the bonus shares are acquired by the company or issued by the company or to the assessee on or after 1/4/2001, the acquisition value is zero. So in this case, the acquisition value is zero, and hence there is a profit of 95 lakh rupees, which is a short-term capital gain on which he has to pay 15% tax. Because to my knowledge, short-term capital gain attracts a tax of 15 percentage, whereas long-term capital gain attracts a tax of 20 percentage. You can Google search or you can find out from pertinent websites of the government of India. Next one is capital. Now we are taking up a new topic in the on capital asset, capital gain, but the asset is something different, and the asset is rights issue by the company. Rights shares are issued by the company. Rights shares. This is a very big problem. You have to pay attention. Rights shares issued by the company. Rights shares issued by the company. By the company. Now, what do you mean by rights shares issued by the company? Now, please remember, in this season, for the last 6 months, that is before this date, prior to this 6 months, I have witnessed so many companies coming out with rights issue, and one among them was Deepak Fertilizer. So many companies. Okay, Reliance also came out with the rights issue, if I remember. Okay, now what do you mean by rights issue? If you want to solve the problem of this particular capital asset, which is rights shares sold and right entitlement, you should know what do you mean by rights issue by the company. Rights issue by the company. Rights issue, or which is also called as rights shares. Now let's talk about rights. Rights. Now, for example, let me take a small example. For example, I am a shareholder of Reliance Industries, and I am having 10,000 shares. Okay, there may be there are so many shareholders like me in the company. This is one part. Second part is Reliance Industries is contemplating to come out with a new factory, and the money required for setting up for this factory is 25,000 crores. So what are the options in front of the company? It can take a loan, or it can issue debentures, it can issue bonds, or it can take it in the form of bank loan. Last but not the least, it can come out with rights issue. Rights issue. Now, rights issue means what? To the existing shareholders, they are telling that they are announcing that the company requires 25,000 crores, and why don't you invest in this company's rights, company's investment of 25,000 crores on the basis of the number of shares acquired by you. For example, uh, in this case, I have 10th own shares, and the company told that the rights issue is for every one share held by you, or 20. For example, the company has declared like this: for every 20 shares held by you, you can invest to the in the rights issue one share at a rate of 600 rupees. Okay. Now let's calculate in my case how much I can invest in this company's rights shares, which will be helpful to garner 25,000 crores for setting up of a new project. So the rights issue ratio is 1 is to 20. Means what? For every 20 shares held by the existing shareholders, you will get an option to exercise one share of rights to be purchased at 600 units, 600 rupees per share. Now, in this case, how many shares I got? 10,000 shares. So, if now I want to calculate how many shares I can purchase at 60,000 at 600 rupees is, so 10,000 shares I got. The ratio is 20 is to 1. Okay. So, cross multiply it. If you cross multiply it, 10,000 into 1 by 20, I can subscribe to 500 shares. Okay, means I have got the right to invest in this company's shares, and I can invest up to 500 shares at each to be purchased at 600 rupees. So I will invest 3 lakh rupees in the new company, in the company's new shares, which are right shares, rupees 3 lakhs. Now please look here. The correct the price at which it has been issued is 600, and the market price is 900 rupees. So what is the benefit I got? I got the benefit of 300 rupees, for example. Now, other option. Now, I am not interested in investing in this company's right shares because I don't have money, or neither I am interested. So there are two reasons why I'm not interested. One is I don't have money to invest, or neither I am interested because I don't find this is very lucrative. So what I can do in the stock market, I can sell these 500 shares, which are called as right entitlements, to any guy who is interested. So this is called a sale of right entitlement, and I am renouncing that right to in the favor of a third person through the stock market operations. So right entitlement also are listed on the stock market. So let's talk about solving the problem. We'll go directly into solving the problem. That will make our discussion very fruitful. So the background of the practical aspect is given, the theoretical aspect is given, like what is the cost of acquisition and all that stuff of rights issues, right entitlement, and right renuncy. Let's take up a small problem, and this problem will make you understand what do you mean by rights issue, what do you mean by renouncement of rights issue, what is the way it is being sold in the stock market, and what is the benefit of all that stuff we are going to talk about. So Mr. S. Ramesh Kumar Mehta purchased 10,000 shares of KIL, Kirloskar Industries Limited, you can take, at 120 rupees per share on 15/10/2018. So this comes under the financial year 2018-19. So this is number one. Number two, on 28/6/2019, that is in the year 2019-20, the company declared one rights share for each share held. Okay. Now means 1:1 is the rights share, rights issue. Means if I hold 10,000 shares, I will get 10,000 rights shares, and for every right share, I have to invest 150 rupees. So I have to invest how much? 10,000 into 150 rupees, which is around 1.5 crores. Now, why should I invest? Because see, the price at which it has been issued is 150 by the company, and the current market price, for example, is 250. So I will get 100 rupees advantage. So that is the meaning of it. Meaning, generally, it is more than the market price. Please remember that. Number two, Number two is now I don't have that much of money to invest in the right shares, because I told you 10,000 shares I have to purchase right shares into 150 rupees is around 1 lakh, 1 crore 50 lakhs. So I don't have that much of amount to invest in the new right shares. So what did I do? Yes, Ramesh Kumar Mehta renounced, means he gave up 30% of rights in favor of Ajit, Mr. Ajit Kite at rupees 30. बोले तो इसमें से मेरे पास राइट्स कितने हैं? 10,000 shares I can issue. I can subscribe to the rights issue. But out of these 10,000, 30% is 3,000 units. I sold to a person called as Mr. Ajit Thite. Okay, and the balance of 7,000 shares I subscribed at 150 rupees. So this is also clear to you. Now both these fellows, now how many shares I got? 10,000 old shares and 7,000 new shares. 10,000 old shares were purchased at 120 rupees and 7,000 new shares are purchased at 150 rupees. And I am selling it at 750 rupees. This is one part. Now Ajit Tite has also got some shares because I have renounced my rights in his favor. So how many shares I have renounced? 30,000 shares, 3,000 shares, which he purchased at 30 rupees from me. Plus he is spending 150 rupees for investing. So the total amount he has invested is 3,000 into 180 is equal to 5,40,000. And within 6-7 months, he is selling it for 750 rupees because rights issue are on 28/6/2019 and sold within 7 months or 8 months. So he has made a bumper profit. So this is a long-term capital asset. In my case, some of them are long-term capital assets and some of them are short-term capital assets. Let's see the problem. Let's look at the solution. The solution is like this as far as Ramesh Kumar Mehta is concerned. Now Ramesh Mehta, I have written clearly the date of acquisition. Original shares 10,000 at 120 rupees. So total acquisition is 12 lakhs. The original shares were purchased at 120 rupees and the original shares were purchased on 15/10/2018 and the number of shares purchased were 10,000. On 28/6/2019, the rights shares he has subscribed were 7,000 shares. And how much was the subscription price? 150 rupees. So he invested 10,50,000 rupees. Who is the SSC? Now I am talking about S. Ramesh Kumar Mehta only. Number one. Number two, on 28/6/2019, out of this 10,000 shares which he was entitled, he sold in favor of Mr. Ajit Thite 3,000 shares. And what was the acquisition price? There was no acquisition price. Remember, this is very important. He has not got a single pice for the investment. He has not invested single pice on investment. He has just sold this entitlement to Ajit Thite for how much rupees? 30 rupees. You look here. But what was the acquisition price? No acquisition price. So the acquisition price is 0. If you have any doubts, you can think on this. Now let's talk about solving the problem. Now before that, I will look at what is the date on which it has been sold. 1/3/2019. The date of sale is 1/3/2019. 1/3/2019. So please remember it is sold on 1/3/2019. So first one, it is a case of 10/2018, and so this is a short-term capital asset, and this also you can't sell it on this one. So I will consider this as 1/8. Okay, this I will consider as 1/8, or is the date of sale. So this is also a short-term capital asset, and let's look at the solution. So please, I am slightly changing the date of sale. The date of sale is 1/8/2019. Okay, just take a note of it. Just take a note of it. Okay, now let's solve the problem. Let's solve the problem. Let's solve the problem. The solution is like this. The solution goes like this. The solution is, first one is original shares. 10,000 shares, which were purchased at 750 each, so 75 lakhs. Cost of acquisition is 12 lakhs because he originally purchased at 120 rupees each. So 10,000 into 120 rupees each. So 12 lakh rupees is the 12 lakh rupees is the total value of the purchase price. Now indexation should not be done because it is sold within 12 months from the date of acquisition. So indexed cost of acquisition need not be considered. Only cost of acquisition should be considered, which is 12 lakh rupees. So hope this is clear. So thereby he made a profit of 63 lakhs as far as original shares are considered. Now let's talk about the right shares. He purchased right shares. He invested in right shares to the tune of 7,000 units. 7,000 units he has purchased, and he sold at 750 rupees. So the total sale consideration is 52,50,000 rupees. And please remember, these original shares were purchased at original right shares were acquired at 150 rupees each. So 7,000 into 150 is 10.5 lakhs. So thereby he made a profit of 72 lakhs. So this is also a short-term capital gain because this is sold after within 6 months or 12 months from date of acquisition. And for a capital asset like long shares, if they are sold within 12 months, it is a short-term capital gain. Now he's even selling this right entitlement of 3,000 shares each at 30 rupees. 90,000 rupees is the consideration he got. What is the purchase price? No, he didn't have anything to as far as acquisition is concerned. So this is a long-term capital gain. Now let's talk about computation of capital gain in the hands of Ajit Thite. Now Ajit Thite is also a wonderful person. He has purchased it at some 30 rupees. So there is a small minor correction here. I will change it. Now this 3,000 shares again is selling at in the stock market on the set date at 750 rupees, and the total consideration is 22.5 lakhs. Now expenses on transfer is nil as given in the problem. So net sale consideration is 22,50,000 rupees. Now what is the amount he has spent on acquiring this 3,000 shares? One is 30 rupees which he has paid to Ramesh Mehta, plus he has invested 150 rupees for acquiring these shares, because these shares have to be invested, and the investment is 150 rupees per share. If you remember, okay, you look here, you look this point, 150 rupees is per share you have to invest as far as rights are concerned. So this is a small mistake here. You can take into account this. So 30,000, 3,000 into 30 plus 3,000 into 150. And now it will become 4.5 lakhs. And this one is 90,000, which is 5,40,000. 5,40,000. So here the total acquisition price is 5,40,000. The sales is to 22,50,000. Thereby he makes a profit of around 17 lakhs 10,000 rupees, which is a short-term capital gain from the entitlement. So hope you have understood these problems. If you have any doubts, you can let me know. Just wait for. So if you have just a moment. Hope